You know PayPal. For what feels like forever, it's been the go-to name in online payments. A true fintech giant with, over 400 million users? But right now, that giant is facing an absolute five-alarm fire. We've got to dive into this because the numbers are just, they're staggering.
Just look at this. The stock has been sliced in half in just the last year. We're talking tens of billions of dollars in value just gone. It's hit lows we haven't seen since 2017. Honestly, for a company this big, a collapse of this scale is something you almost never see.
And that freefall brings us to the core of the whole debate. The real paradox here. Is PayPal a dying relic, a dinosaur about to be wiped out by newer, faster tech? Or is this a massive, historic overreaction, creating maybe the single best buying opportunity in the entire market? Let's break down both sides.
Okay, so first we need to really appreciate just how quickly this all went down. This was not a slow bleed. This was a sudden, absolutely brutal plunge that pretty much caught everyone off guard. So let's imagine this hypothetical scenario in early 2026. The year starts, the stock's kind of hanging out around 60 bucks. Then, boom, February 3rd, they drop a bombshell. Not only did they miss their earnings targets and give weak guidance, but they also announced the CEO was out. The market completely freaked out. The stock dropped almost 20% in one day, and just a couple weeks later, it cratered to its low point.
So, why the complete panic? Well, this leads us straight into the first argument, the idea that PayPal is a classic value trap. You know, it looks cheap, but it's cheap for a very, very good reason.
An investor on social media just nailed it, calling it the Peruvian fax machine level of cheapness. And that's just hilarious and brutal, isn't it? It's basically saying, sure, a fax machine is cheap today, but would you really want to own one when you have email? That is the exact fear with PayPal.
And here's the textbook definition. A value trap sucks you in with these really attractive numbers, but under the surface, the business itself is fundamentally broken. It's on a downward slide that could last for years. So what's the evidence that this is what's happening to PayPal?
All right, now this slide, this is everything for the bears. Forget the other numbers for a second. Just look at that top line, branded checkout growth. This is PayPal's bread and butter, their most profitable business, that classic Pay with PayPal button. It's slammed on the brakes, slowing from 6% growth all the way down to just 1% in a single year. That's a 500 basis point drop, a full 5 percentage points. That's not a slowdown, it's a catastrophic deceleration. It looks like their main engine just hit a brick wall.
And here's why that's happening. The competition is just relentless. Think about it. Apple Pay is baked into every iPhone. Checkout takes, half a second? Google Wallet has the Android world locked down. And if you're an online store, Shopify's own payment system is proven to boost your sales. So the real question is, why would you bother logging into PayPal when these faster, smoother options are right there?
Okay, so that's the doom and gloom case. And you got to admit, it's pretty convincing. But there is a completely different side to this story. A powerful argument that this isn't a trap at all, but a huge turnaround in the making. Let's see how that case gets built.
It all begins with the price. I mean, this visual just says it all. We're looking at the PE ratio, which is just a fancy way of asking how much you're paying for a dollar of the company's profit. PayPal is trading at about 7.5 times its earnings. Its competitors, they're trading at double, sometimes triple that. So by this measure, PayPal isn't just cheap, it's practically in the bargain bin.
And seeing that rock bottom price, what's management doing? They're putting their money where their mouth is. They've announced a plan to buy back an incredible $6 billion of their own stock this year alone. Now that's a massive signal of confidence, but it's way more than just a signal. It's actually a really powerful financial strategy.
Yes, some people call this the cannibal strategy. It's pretty cool. Even if PayPal's profits stay completely flat, by using their cash to buy back and basically retire their own shares, the value of every single share that's left goes up. It's a way to mechanically push up the earnings per share for investors, and it acts as a huge safety net for the stock.
So how does PayPal fight back against the speed of Apple Pay? Biometrics. The plan is to completely get rid of the password. You'll log in with your face or your fingerprint, making their checkout every bit as fast as the competition. And the impact is clear. Merchants who turn this on see their sales conversion jump by up to 5%. That is a huge, huge incentive for them. On top of that, the bull case says that at this crazy low stock price, you're essentially getting several huge growth businesses for free. Venmo is growing at 20% a year.
Their buy now, pay later service is exploding in popularity, and they're even getting into AI-powered travel. These are not little side hustles. These are massive businesses hiding inside the company.
But here's the thing. Both the value trap argument and the turnaround story, they really hinge on one massive wildcard: leadership. The company's entire future now pretty much rests on the shoulders of one person.
Meet Enrique Lores. He's the new CEO, brought in from HP. He's a longtime veteran there, and he's been given a very clear two-part mission from the board. Number 1, clean house and restore discipline. Number 2, hit the accelerator on innovation.
And you can really see this stark contrast here. The old leadership was criticized for having lost its mojo. The new mandate for Lorius is to be ruthless, to clean the decks, impose some serious operational discipline, and get PayPal moving fast again.
And if you want a sneak peek at his playbook, just look at what he did at HP. He led a massive transformation built around AI, he was aggressive about cutting costs, and he simplified the company's structure. Investors are betting he can run that exact same play at PayPal.
So let's put it all together. A trap or a turnaround? What makes this whole situation so fascinating is that the evidence for both sides is really strong.
So on one side of the coin, you have the value trap argument. A company whose competitive edge is eroding, its core business is slowing to a crawl, and it's facing huge risks with a new CEO. But on the other side, you have the turnaround case, a stock that's just dirt cheap, a company printing cash and buying back billions in stock with huge potential in new growth areas, all led by a new CEO who knows exactly what he needs to do.
And that brings us right back to the central paradox. Is this company a value trap disguised as a bargain, a fax machine in the age of AI? Or is this a true turnaround story in the making, a moment of maximum pessimism creating a once-in-a-decade opportunity? The next year is really going to tell the tale.